George Robertson, pleasure to meet you. Welcome to Face.
Yeah, do you hear me there?
I got you, George. How are you?
Pretty good, good. I'm complimented you had me on.
Thanks for granting it, George. I saw you on Twitter, and looks like interest rates and bonds are your bailiwick. And before we get going, I always like to find out a little bit about people's journey, how they get from point A to point B. So, I went to your Twitter stream, and it said that you started at Sali. Was that Sally Mae or Solomon?
Solomon Brothers.
All right. Okay. Great big bond house. So that was your first job in the industry. Were you thinking before that you wanted to be involved in the financial markets?
I got to confess, it wasn't my first job in finance. I was a stockbroker in Toronto with my Harris tweed jacket and my gray slacks.
Yeah.
And I had a few dentists as my clients. And I did such terrible stuff to them that I was scared that I'd never get my teeth fixed ever again in Toronto. So I picked up whatever I had and came down.
Did you have to leave Canada? You're down in the States now?
I had to leave Canada, and it's for me, it is not safe yet. So that's my. I won't go too far.
Can you explain your handle at Bicker and Brattle?
Yeah, Bicker and Brattle. That's I apologize for that. Sorry about that. Okay. I apologize for that. That's from Robert Burns. It's about the mouse where he's plowing his field and he finds a mouse nest that he ripped apart. And it's just it's a poem about the inexplicable tragedy, chaos that can happen when you think everything's nice and cozy and you're in your little mouse hole. And there you go. So that's Bicker and Brattle.
Okay. All right. Thank you, George. So, I did go to your stream, and it's time to talk a little bit, talk some markets with you. So let me just share. So, this has been one of the worst bear markets in my career. And I don't know if it is in history, but in my career, I mean, TLT from 170 to mid 80s in a couple of years. I'm starting to see some technical signs that we could be setting up for at least some type of bear market rally. Doesn't sound like, or what I see, that you talk a lot about directional stuff in interest rates. But do you have a view? Because go ahead.
Yeah, I do. And it was really interesting. I sort of eavesdropped on you guys about a couple, 10, 20 minutes before this forum. And it was a lot of discussion about things that usually I haven't had too much involvement. A lot of technical analysis, a lot of, double tops, triple whammies. Now, 20 years ago, I would have been somewhat dismissive, but now I'm not at all. In fact, Matt, I think that's where it is right now, because people are overthinking the macro. There's really massive flows going down, but they're only happening about every 6 months to 18 months. There is not this constant meme that's going around about, if Powell will do this, if employment does that, and so on. It is not a responsive market now to macro. There's just 2 or 3 things. So what really counts now is just to be a superior risk manager. And that's where the respect I have for the approach that I heard was that if you might catch some things, maybe you get 55% average that you actually called the market. But one thing you don't get caught up in when you approach the market with the detail of the levels that you guys look at is you don't get cut off and you don't get cut off at the knees and destroyed. You're always very close to
know where you're wrong before you pull the trigger, and
right.
then and have your stop there.
Yeah. And so I think what is really interesting is that I don't know if I'd call it a bear market or a bull market. What I do think is that we have a fascinating situation where the last 30 years of uncertainty of what the Fed was doing, that the market was very confident they knew the Fed, that they knew Treasury supply demand, they knew all these variables cold, so that it was just plug and play as we got into an era where none of those variables really count anymore. We're waiting for the big event. We've got the stage set. We got everything going, and I'm not talking about doom and gloom and the U.S. is going to blow up or go bankrupt or anything, but I am talking about a very significant regime change where we're no longer under like the autopilot of the Fed taking care of us. Sometimes you're wrong, sometimes you're right, but you can count on the Fed. The Fed's not there, and I
Okay.
say that not as a debater like an anti-Fed guy. But I say that just because I don't see any signs of the Fed in terms of the macro economic analysis, the monetary economic analysis that I do and have done for decades. So that means that to be very, very conscious of price levels and innate understanding of volatility and risk is probably the way to go as we wait to see where this goes, where it plays out.
George, any comparison to the 70s?
Yes.
So I mean, there are a lot of things that have parallels with the 70s, and wondering if we're not in that we went through that type of regime. And also what's interesting is, what they brought back, the old term I hadn't heard for a few decades, bond vigilantes. The
Yes.
bond
Yeah.
vigilantes are back, and we hadn't heard about them for a couple decades.
Right.
So
What was it? Carvel said if he died, he wants to come back as a bond, right? Scare the hell out of everybody.
Yeah.
It's in my approach, I don't really see anything bullish or bearish in yield. I see treasury yield as being reflective of the very long-term potential in NGDP growth. And NGDP growth, of course, contains real growth and it contains inflation. So where the 5 years going right now is, I think there's two things going on. First, it's quite normal that if this NGDP growth is going to stick with us for a while, that the 5 years should be here. Actually, I think it's going to go higher. And then the second thing going on is that the Fed went on for a very aggressive experiment that I don't think was really discussed much, which was from 2012 on. QE, they sold it as like an ease. Well, it's not an ease at all. What it is a very large, significant redo of how the banks are managed and overseen by the Fed, in particular, the reserves. That being the case, the QE was actually not an ease. What it was a moving from not just controlling Fed funds, but basically taking over the whole curve. So we had a bit of this from Fannie Mae back in the Reigns time and in the end of the 90s. But it was just a bubble. And we had some of it in the 80s when World Bank couldn't do anything more than the 5 year. But we have an extraordinary move by the Fed that it dictates not just Fed funds, but 2 years, 5 years, 7 years, 10 years. And then duration starts to be a bit of a problem. So it doesn't quite.
Didn't the Fed tell all the banks to load up on long duration a few years ago when rates were at 130-year lows?
Yeah, I don't think they dictate things like that. But
how did it happen then that they all got
it
loaded up?
Because if you have a couple $1 trillion coming sort of force fed into the banks, like here's the money that we're going to give you because we're actually holding it. And it was the Fed that more or less maxed out on the 10 years and the 5 years. And so I don't think, as far as I can understand by looking at the bank balance sheets, I don't think they're really in that a challenged position right now. I'm sorry, I'm in Europe right now. I'm visiting my son.
Where are you?
Well, it's I'm in Garmisch, Germany.
Okay.
The NATO army base.
Okay.
As the Fed built these reserves up, they just sort of stuffed it into the banks, and then they dropped the curve. It used to be I forget what that rule is, 3, 3, and 10 or something like that, where you just show up at 10 o'clock in the morning and you do this and that, and you would just ride the curve, and the Fed would hold things steady, and everything was in good shape. Well, the Fed just took that away from the banks, and it just said, here, here's another 3 trillion, 5 trillion in terms amongst all of you, and go put it to work, or at least give it back to us, which is what they did. And there wasn't any yield. There was no curve. The Fed destroyed the curve. So I think that led up to what you're talking about, is that they started to incrementally add duration risk so as to get some sort of cash flow or earnings. But the banks are the system's pretty sound. And these reserves are very, very large now versus what they were about 10 years ago. So I don't think that's a problem. I think what the problem is the Fed's aggressive and even hubris that they can command every risk-free rate there is from Fed funds right out to 10 years.
Okay, and what are the risks of them doing that? People say something breaking, the rollover of debt that corporations are going to have to go through, and everyone say next year that it's going to be sticker shock where they were financing and where they're going to have to roll over to.
Well, I'm probably going to
surprise me
there. I'm probably, I'm just going to disappoint you, is that U.S. Treasuries are perfectly fungible. Like, in other words, I give you $1 trillion, you can give me $1 trillion. And if I drop it to 500 billion, you drop it to 500 billion. They're an asset liability problem always, as far as the macro and monetary economics go. So there is no demand supply problem for the system. It just doesn't exist. And that's what I said.
Just lost you. Are you still here? George? He's gone. All right, well, that's showbiz. We'll get George back, everybody. I had some questions to ask. Anyway, thanks for being here on Turnaround Tuesday, everyone. Good hunting the rest of the day. We'll see you tomorrow, and I'll reschedule George. Guy had some interesting things that I wanted to talk about, but we have to adjust. So don't just count your pips, count your blessings, everyone. And we'll see you tomorrow. Could join the team. A little less than half an hour for the morning edge. And it's good to have internet back. Great to be back with everyone. See everyone tomorrow. You're welcome, Mary. All right, guys. Adios. Hold on. He's back. George is back.
Hi.
Hey, George. Okay, you're back. All right. So
I apologize. I left my phone. Anyway, that's my excuse is I left my phone and stuff, so I had to buy one of these Apple things, and I hate Apple.
Okay.
And sorry about that. But what I'm saying is the treasuries are an asset liability problem always, for the government, for the Fed, for the banks, for pretty well everybody. And in fact, they're identities. That means if you do something like this or that, then you will have you'll have a corresponding balancing out of it. And so it's not a problem. This is a hard concept for people to come to terms with. They're always trying to say, well, if there's only 500 billion of issuance at this 1 month, and now there's $1 trillion, it must be that there's a supply demand problem. And that's just not the case, or at least it's never been the case in my experience.
That's what everyone's talking about. The supply that the government is crowding out everybody, and you're saying that's not true.
No, it's. I think there could be small effects on like the 5-year, the 10-year, the repo markets, and we have seen in the repo markets. But as far as like setting the 10-year rate, the market rate, how it trades right now, I think that's completely a function of the Fed still administrating rates and letting it go as they do QT, as they start to let some of the treasuries go. in which case the Treasury is going to move to where the real rate is right now in terms of where 10-year U.S. risk-free, not just necessarily the U.S. Treasury 10-year, is pricing the risk of the NGDP and inflation and, what Marjorie Greene's going to do and what the Fed may or may not do. It's not an issue of supply.
Okay, so do you think the 10-year could trade up towards 6%?
Yeah, I'm pretty. I have I have a lot of comfort in that call, more so than I've been in the last couple decades, and it is completely a macroeconomic, monetary economic call. The problem with this call is that it doesn't have a mem. It doesn't have anything for anyone to do month to month, week to week. And likely it's going to take place, as we've seen it in the last couple of weeks, with very significant jumps up and then just sort of faded and people trade. And then you get a very technical approach to it.
So we have kind of like it's getting parabolic is what you're saying.
I think it's, I would use some of my option experience. I would call it a jump to fusion. But that means that the volatility is maintained, but then you get a whacking, up 10%. Are down 10%, and then you digest that, and then you go back to the regime of vol that you have in the market.
Okay. So with that forecast, George, you're sanguine about equities, and I believe you said that there should be no reason why we can't see 5,000 S&Ps, and and that's including what you're thinking on yields. Where the market has been so resilient in the face of higher yields, in the face of a stronger dollar. So you're sanguine. Does that mean that earnings are going to keep coming through? No, even though yields are headed higher?
I think I think earnings, well, that's another rabbit hole I can dive into. Ever since the S&P 500's leaders have been so concentrated in only 4 or 5 key people per company.
The Magnificent Seven.
Yeah, they're really not too. They're not too worried about earnings. They're worried about I don't know, the politics, the power, their legacy, where they're going to go for the next 10 years. They want to get rocket ships launched and important things. And it's not like it was even 10 years ago, where quarter to quarter earnings really counted. And then the second thing, we have all these massive offshore tax schemes, basically scofflaw schemes to avoid paying taxes in the U.S., which even though Theo/Trump dropped corporate tax down to 12% or so, it's still not equivalent to the Irish tax rate of, I don't know what it is, 7%, 8% now. So that gives them a huge room to put their IP and various other licensing rights in Ireland, do all the industrial wherever, making the stuff in China or how have it, and their marketplace in the U.S. and avoid paying taxes. Now, what this ends up with is that they're very, very forceful in terms of managing their earnings. If you look at the NIPA, this is the Bureau of Economic Analysis counts of all the corporate profits in the United States. You'll see very quickly that.
Do you have that up here, George? On your hub page?
In the where do I have that? That's my whiz bang set. That with the verbiages. But anyway, the U.S. The Bureau of Economic Analysis says that corporate profits for the nation are at record highs. Just there it is, right there on that side. And this graph you're having right here is the national accounting of corporate profits for the nation. It is sort of plateaued there for a bit, but it is at very strong right now, and it's not showing up in S&P earnings. So I think what all this adds up to is that the S&P earnings are not quite as much as the drivers they were like 10 years ago. And again, I'm speaking in terms of macro flows that are taking 3 to 8 quarters to play out right now, which are probably beyond the career objectives of anybody that's trying to make a living week to week in the marketplace. So it is, yes, I'm right, but then who cares? What we have to do is figure out what to do week to week, day to day. And I think that's where all
Do you trade, George, at all? Do you trade?
I used to trade a shitload, but back in the day, I still trade from my personal account.
Yeah.
And I've found that the trading I used to do, which was more akin to like, making flour out of grain, and what right now, what you try to do with your personal account, even if it's of some substance, that is 15 times harder than it is to trade for a large institution.
Yeah. Okay. All right. And anything actionable that you see? Are we at any kind of inflection point? I mean, my original question was, say, for example, TLT got down to 84. I'm starting to see some technical divergences here for the first time. In fact, big picture on TLT, let me just go to it. So we took care of some unfinished business a week or so ago, and that was clearing out the October low. Okay.
Yeah,
So the October low. So
I would be a little careful with that. I would stress that when you feel that the trade is to short TLT, because I don't think we've seen the end
yeah.
of these rates rises.
Okay.
Then,
So
then be a little
sell a
more,
rally.
be a little more comfortable with that trade. And then
Okay.
if you do go the other way, which I obviously caught a couple of these waves that have worked out quite well, just be more than usually cautious in terms of how long you stick.
Okay. Anything on the equity side? You have conviction about the S&P's trading towards 5K?
Yeah, I'm fairly comfortable on that. Is it December? Is it next quarter? I'm not certain, but I do know that the major, if you look at like not just like the analysis that you're applying in front of me right now, if you just look at like what is the core, the central theory for all bears right now, and it is that the Fed has induced a monetary cycle and it is tightening, and we might get some more Fed funds up or maybe nothing, but that is more than enough for anybody with any sense to look forward to a lowered NGDP, higher unemployment, and therefore a bear market. The problem with that is that it doesn't show up in any of the macro flows. There basically is no Fed in terms of being able to affect that type of change in NGDP. And if the S&P 500 were to trade aligned with the NGDP that we've seen, since April 2020, it should be well over 5,000.
Okay. Do you have any kind of business? You're just doing this to, educate people and share your views?
I'm sort of casting around what to do with a lot of time on my hands right now. My risk manager, my partner at home, says that I'm retired, but I'm not too keen to do it. My habit was 12-hour days, so I'm still at it.
Okay. Have you ever been to a retirement dinner for a financial trader?
Usually they don't make it that long.
Yeah, there you go. My retirement plan is slumping over my keyboard.
Right.
So, anyway, George, really a pleasure meeting you. I'd love to talk to you again, and as things move forward towards the end of the year, and see if your
Sure,
views
and
have
I'm
changed.
I can take it. So if I'm
All
sitting
right.
there going biddy, and the S&P's at like 3,000, have at me.
All right, well, I'll be gentle. All right, buddy.
Okay.
All right, and you
All right, sure.
survived an interview with Dale Pinker, makes you my trading warrior brother now.
All
So
right, great.
everyone, George Robertson, if your interest is bonds and yields, he really has from what I've seen, and I do a lot of intelligence gathering, really interesting and different types of ways of looking at what's happening in interest rates that a lot of people in a conventional sense do not. So check him out at Bicker and Brattle, George Robertson, and check his charts out on his R Pubs evaluating. He's got some real interesting charts there. So thanks
Okay.
again, George. Appreciate it,
Thanks,
buddy.
yeah, great compliment. Thank you.
Hey, have a great trip and a great visit with your son and safe journey home.
Okay, thank you.
All right, that's a wrap, everyone. Remember, don't just count your pips, count your blessings. See everyone tomorrow. You join the team in 15 minutes on the Morning Edge. Adios.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.